So, what if you want to invest in real estate, but you don't like the hands-on aspect of it? A popular option are REITs, real estate investment trusts. They're companies that own, operates, and finances income-producing real estate. They allow individual investors to earn dividends on real estate investments without having to buy, manage, or finance any properties themselves. There are a couple main types of REITs: equity, mortgage, hybrid, sector specific, and note that REITs can also be categorized based on the type of properties they own. So let's talk about some of the regulatory requirements REITs have. There's a 90% payout rule in the US. They're required to distribute at least 90% of their taxable income to shareholders as dividends. 100 shareholder rule. They have to have at least 100 shareholders after the first year of existence. Diversification. No more than 50% of its shares can be held by 5 or fewer individuals during the last half of each tax year. So how do you invest? You can do it directly through a stock exchange, which can be accessed through your brokerage account. So very accessible, right? There's not many barriers that's going to prevent you from buying this. You can buy through a fund, ETFs, and private REITs, which are now publicly traded, typically only open to accredited investors, which are people with at least 200K annual income or a net worth of over 1 million. So some benefits: allow for diversification in real estate without actually owning physical property. Liquidity: since it's on the stock exchange, it's easily bought and sold compared to real estate, which if you own a property, it's a really big hassle to sell real estate. So there's not a lot of liquidity and there's a lot of closing costs that take away from your gains. So lack of liquidity in real estate that REITs do offer. Dividends: REITs typically have some of the highest dividends in the stock market. Professional management: these real estate investment trusts are managed by teams of professionals. So some risks: they're subject to market volatility like any other stock, right? So that's something that can make them very volatile. Interest rate sensitivity, particularly for mortgage REITs. When interest rate rises, the cost of borrowing can exceed the income from assets. Management fees. Fees can eat into profit. Economic downturn. Sensitive to economic cycles, similar to real estate. So unfortunately, REITs are usually taxed as regular income, not qualified dividends. Qualified dividends have lower tax rates. And like a stock, if you sell your REIT investment trust at a profit, you're going to be subjected to a capital gains tax. Some key metrics that you want to look at when evaluating REITs is funds from operations. Similar to earnings from other companies, net asset value, total assets minus its liabilities, occupancy rate. Higher occupancy rate means higher income, right? So you want the buildings to be occupied. Debt to equity ratio. You want to evaluate how much debt to equity is being used to finance acquisitions. Sometimes people think that using debt at all is surely risky, but in the finance world, using debt to finance shows that the company is taking advantage of its opportunity and they don't need to sell equity, right, or stock to make investments. So it's another form of finance.